Folks, a once-in-a-lifetime opportunity starts today. And sadly, most individual investors are going to miss out on it. The next few months are going to make a lot of millionaires, but a lot of people are going to miss out. Now, look, I'm going to read you some data, and I want you to pay attention. We have CPI inflation at 2.8%, the Fed interest rate at 5.7%, the GDP growth at 2.7%, and corporate earnings on the S&P 500 growing by 14.5%. The data I just read to you, that data isn't 2024. This is 1995 numbers. Now, why am I talking about 1995 numbers? Listen up. 1995 marked one of the biggest bull runs in the history of the stock market. It made a lot of people rich. It made a lot of people life-changing money. From 1995 to 1999, the S&P 500 did 200%. That's 50% a year. Now, the NASDAQ went even crazier. The NASDAQ did 440%. That's 110% per year for 4 straight years. Imagine if you own a company with a 3 beta. That's 1,200%, 1,300%. This is insane. This is life-changing money. This is big. Now, I want to show you some data, and then we'll talk about the current setup of the market. But I think we're looking down the barrel of a massive bull run for the next few years. Of course, it's not going to be straight up. Now, people think that when I say these things, I mean that from this point on, for the next 4 years, we're going to shoot up on a 45-degree angle. No, there's going to be a lot of bumps. There's going to be a lot of crashes, a lot of pullbacks, a lot of scare events that are designed to shake out the weekends. And one of them was just a preview. The August 5th, Monday, was just a preview for the bigger crashes, the biggest drops that are still in the barrel. And they're going to scare a lot of people.
Since 1928, the most common month for the summer low is August, and the most common week is the first week of August. So I think maybe the worst is behind us, but it doesn't mean we're straight up from here.
We had massive CapEx investment cycles, massive R&D investment cycles in 1995. Companies like Microsoft, like Intel, like Netscape. Netscape in 1994 basically was considered to this day kind of the invention of broad use retail internet.
Imagine a world where every word ever written, every picture ever painted, and every film ever shot could be viewed instantly in your home via an information superhighway. And in fact, that's already happening on something called the internet, that anyone in the world with a computer and a modem to connect it to a telephone line can subscribe to.
All of this craziness that happened basically is repeating itself today with the same CapEx investing cycles and R&D investing cycles with AI, with NVIDIA, with Microsoft, and similar companies. But the times have changed, but the concept is pretty much the same. Just like we had the internet pop in 1994 and the massive bull run came for the next 5 years, the AI cycle is just in its diapers. It's just starting out.
We are just in the early stages of a bull market. And if you look at what we've seen from AI revolution, just from broader tech, it's been strong from an earnings perspective. And the growth scare that we saw, it's just a bump in the road to what I believe is really this fourth industrial revolution playing out. And that's how we've handheld investors through this. This is the time to own tech. And I believe it's really just the start, still 9 p.m. in an AI party that we believe goes to 4 a.m.
In 1995, the inflation numbers were 2.8%. The Fed was at 5.75% interest rate. Right now, we're literally at 2.9% inflation and 5.25 interest rate. So it is almost an identical setup. Now, what happened in the next few years is that the Fed took the interest rates from 5.75 to 4.75 for the next 3 years until 1998, and inflation dropped to 1.6%. So we had a 3-year cutting cycle of 1% and inflation dropping from 2.8 to 1.6.
What exactly are the parallels between now and circa 1995?
The main parallels are that we have inflation that is lowering and an economy that is not collapsing. You've got the labor market that's slowing, consumers hanging in there. Inflation peaked 2 years ago and is now under 3%. So the Fed is in a good position here if they can be proactive enough with the economy still showing some resilience and inflation way past its peak. You've still got a good chance to soft land this economy. That means slowing growth enough that the Fed cuts, and then you begin to see credit prompt or promote more growth. So that's a good sign, a very strong connection between now and the summer of 95.
The crazy part about this that it doesn't end there. The GDP, the gross domestic product growth in 1995 was 2.7%. Right now, it's at 2.8%. It's almost identical. In 1996, we went up to 3.8%. Then in 1998 to 4.5%. And in 1999, we hit 4.8% GDP growth. That cycle was fueled by globalization, by the internet. The baby boomers were peaking. The globalization was taking over. And the internet was basically creating a lot of new business. That created massive growth of the economy. Right now, we have a whole new digital economy starting out. And on top of it, we have the whole AI revolution basically changing the way everybody does business. We've seen people at these Palantir events talk about how this new system, the AIP, essentially takes a thing that used to take weeks to get done, and it does it in seconds.
We run a model, we score our database, we execute, we wait 6 months to see what happens, and then we collate a lot of information, we argue amongst ourselves. We used to have 6 weeks to make those decisions. Now we've got to make those decisions in milliseconds. So Foundry and AIP have been terrific for us. We actually launched the first prototype within 45 days. And that was just amazing from my perspective.
This is a game-changing event that we're seeing in front of us right now with AI basically revolutionizing how business is done. And that is going to translate into more GDP growth. Now, people are skeptic, and I get it. People will always say, oh, a recession is coming up, a crash is coming up, geopolitics is a mess. Over the past 15 years, you had a lot of reasons to sell. But at the end of the day, the S&P 500 went up by 700%, 15% per year, despite all the crashes and the collapses and all this crap. Now, look, even if you look at earnings, S&P 500 earnings in 1995 grew by 14.5%. If you look right now at the tech sector in the S&P 500, which is Microsoft, Nvidia, Google, and all these companies, the tech sector essentially grew by 15% in 2023 and is expected to do 12% in 2024. We have a cooling down inflation, GDP growth on the move up, and corporate earnings that are improving and are staying strong because of this new cycle. Then it was the internet, and now it's the AI boom. And yet, despite all of these similarities, and despite all this great setup, the stock market hasn't really gone to hyperdrive yet like it did in 1995. Yes, we've seen a 40% rally on the S&P 500, but if you go back all the way to December of 2021, from December of 2021 to now, the S&P 500 did 16%. That's like 5.5% per year. The NASDAQ did 5.8% per year, giving us 17.4%. The IWM, the Russell 2000, the small caps, actually lost 12%. And the market gave us nothing for the past 3 years. We've seen a bounce back, but not really that hyperdrive we've seen in 1995. Now, look at the AI boom, right? The invention of ChatGPT in November of 2022, let's call it the equivalent of the invention of the internet in 1994, right? Well, since the introduction of Netscape in 1994, for the first 700 days, the market, the NASDAQ, was up 120%. Since the invention of ChatGPT, we have gone through about 630 days, so almost 700 days. The NASDAQ is up 65%. S&P is up 44%. We're still halfway to where we were in 1994. And ChatGPT is actually a lot bigger than the invention of internet as far as the impact it's going to have on businesses. We've seen just the beginning of it. Right now, what we have is a setup that's very interesting. The CPI is at 2.9%. Retail sales have just doubled from 0.4 to 1%, doubled than expected. We have Walmart coming out saying, hey, earnings are great. People are buying like crazy. Job claims actually better than expected after the initial scare we've seen from the unemployment stuff. We have Warren Buffett buying consumer discretionary, Ulta. We have Bill Ackman buying up Nike. GDP is at almost 3%, and everybody's still fearful. If you look at the fear and greed index, it's on fear. So if it is on fear, it means that the upside isn't here yet, because the upside will be here when everybody's going to be at max greed, not when everybody's at fear. So this setup is beautiful, especially with the Fed starting a cutting cycle. We know one thing. Once the Fed is going to be done with the cutting cycle, the S&P 500 on average gives you 26% in the following year. And that's just the S&P 500 with the rate cut cycle. When you add in good macroeconomic data, good corporate earnings, and the introduction of AI into the business world that's just starting out, you're talking about massive cataclysmic impact that hasn't been seen yet. And when people talk to me about a pullback or a drop, yeah, it may come, sure. But here's the thing. What happens if the market drops is it shakes out a lot of people who don't understand fundamentals, who don't have conviction. The same thing would happen with Palantir. When Palantir dropped from $35 to $7, a lot of people got spooked because it's scary. It's scary. I get it. But the people who had convictions, like me, basically stayed in, and we're back to $32 right now. Nothing happened. The same thing with this market. Me saying, hey, this is 1995. We're going to go to 1999. It's not going to be in a straight line. There might be more scary events ahead. So make sure you keep your head in the game, stay focused, and make sure you don't get scared. I'll see you in the next one.